To this story now, South Africa's economy lost 1 trillion rand under the leadership of former President Jacob Zuma. That's according to the Bureau for Economic Research. It shows economic opportunities were missed and jobs, millions of jobs rather, could have been created if the right moves were made. This is detailed in a report by economist at the Bureau for Economic Research, Harri Kemp. He joins us now live via Skype. Harri, thanks for your time. We appreciate it. 1 trillion rand lost in just 9 years. It sounds like an exaggeration. Tell us how you came to this conclusion.
Hi, good evening. It's a pleasure to be with you. So the research started out, we wanted to look at South Africa's performance post the global financial crisis. So it's been 10 years since the Lehman collapse. There's a lot of retrospectives coming out, looking at the last 10 years, what's happened. And when we looked at the data, we saw that before the global financial crisis in 2008, 2009, South Africa growth tracked the global average quite closely. But after this crisis, South African economy underperformed quite substantially relative to our peer groups and to the global average. And we just decided to look at what would have happened, what could have happened if the South African economy had tracked global growth or tracked some of our peer economies. So if you look at what would have happened if we would have tracked emerging market economies, then you get to this 1 trillion rand figure, or that the economy would have been 30% bigger in 2017. In our opinion, it's more apt to compare South African performance with the global average. And if you look at that, if we had followed global average growth rates from between 2010 and 2017, the South African economy would have been around 15% bigger, or let's say 500 billion rand.
But emerging markets are largely affected by external factors, as some people say, some experts say. For example, trade wars is a big deal as well. Surely that played a part in how our economy suffered.
Exactly. So in the report, we also mentioned that the South African economy is very dependent on international developments. So external factors do play a very important role. We think right after the financial crisis, some of our biggest trading partners were still doing quite poorly. If we think of the European Union, which remains one of our biggest trading partners. We've had the drought recently, and we've also had a decline in commodity prices after the financial crisis. But other emerging markets were exposed to these exact same factors, and still we underperform relative to these other emerging market economies, relative to other commodity exporting countries. We also underperformed. So basically South Africa underperformed even against economies that face these same external factors that might have impacted on their growth.
Same external factors or unique external factors? Because if you look at the drought in South Africa, that would be unique, and the scale of that drought. Also, our mining sector suffered dramatically, which led to job losses. So show me the similarities between these countries that you say had similar challenges.
Exactly. So you're saying the truth. You're speaking the truth. So the drought was very specific. It was isolated to the last couple of years, but even if you exclude the agricultural sector from our GDP numbers, you can still see that South Africa still underperformed. Our manufacturing sector has been under quite a lot of strain, and that's connected to the trouble in the mining sector. Now, in our opinion, a lot of the troubles in the mining sector and manufacturing can be ascribed to policy uncertainty and a lack of confidence in these sectors. We know the mining charter has been plugging along for quite some time. We've recently had a final update on that. We're still waiting for some commentary on the final mining charter, but this has created a lot of uncertainty and policy uncertainty. If you're a mining house, you're not going to go into a 20, 30-year investment cycle if you're uncertain about what policy is going to do. So in our opinion, that is some of the policy uncertainty and the political uncertainty that characterized this period, or some of the unique factors that South Africa faced that led to a lack of private sector confidence, a lack of consumer confidence that filtered through to economic activity.
Harri, some of the reasons that mining companies gave for shutting down shafts, for instance, was mainly because they were running out of raw materials. I mean, it had very little to do with policy certainty because they already signed those deals with government.
That's true. So if you think of our gold sector, running out of raw materials, or our underground stock is very limited at this stage. We're falling quite a bit behind some of the other mining countries or mining economies, but if you look at the platinum sector specifically, we've still got 80 to 90% of platinum deposits globally. So the platinum sector is a sector that should still be doing quite well. But in our view, the policy uncertainty there in terms of finding and exploiting these new sources and these new reserves, that really played a role in limiting investment in the mining sector specifically.
And then, of course, you also say that 2.5 million jobs could have been created during this time, given all of those economic difficulties we faced. How is that possible?
So the 2.5 million jobs that mentioned in the report is actually the counterfactual, where we say if the South African economy had kept pace with emerging markets in general, using a simple set of assumptions, it would be possible that we could have created around 2.5 million more jobs. As I said earlier in the interview, the more apt comparison in our view is when we compare South Africa to global growth. So if we had followed average global growth patterns between 2010 and 2017, we would have created around 500,000 to 1 million more jobs over these 10 years.
All right, thank you so much for your time and your insight. We do appreciate it. That was economist at the Bureau for Economic Research, Harri Kemp.